Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the comments, all the subscribers, and the suggestions for what stocks to do next. Thank you so much for the feedback. Today's episode, we're going to go through Salesforce.com, a monster CRM company that's out there growing and making acquisitions. So we're going to dive through the financials and figure out what we think this business is worth. And like always in this channel, we look at what we think the intrinsic value of the business is going to be, and then look at the public traded price and see if there's a difference, and hopefully over time that difference closes and we can realize an upside return. Now we look for all investments to have 5 key attributes. That would be top line revenue growth, earnings growth, as we define it by EBITDA, right? We're looking at the enterprise as a whole. We want a strong balance sheet, strong free cash flow, and a well-priced stock. Those 5 hallmarks are what we classify as a good investment, and then we look to make an investment if those are met. Behind me is the 10K for Salesforce.com. Please go through and read it. It's fascinating. I suggest reading all 10Ks. They're integral with the investment process, and few people actually take the time to read it. All right, let's dive into the financials here and take a look at where Salesforce has been over the last rough decade, 8-year time period. So in 2012, Salesforce revenue was $2.2 billion, and they have grown that to $17 billion over that time frame. That is a roughly 30% annual growth rate, which is outstanding. And you'll notice that recently in 2018, 19, and 2020, that growth rate has accelerated based on historic patterns. It's gone from 25% year over year to 27 to 29% as they continue to compound and grow. Partly because of acquisitions, like I mentioned at the intro, they bought Tableau for $15 billion, a business that was doing only 6 or 700 million of revenue. They bought for almost 15 billion, which is a lot of jack to pay for an acquisition. That's a tall multiple. Even on revenue, it's big. So I would imagine that someone in their back office did the economic analysis and figured out that they can push that service to their existing customers and hopefully expand revenue of that enterprise very quickly. So good luck to them to make that pay off. It was a lot of money to spend. But not to get sidetracked, let's finish revenue, enterprise value, take a look at what we think the business is worth. So revenue, checkboxed here, 30% growth year over year. Let's look at EBITDA. Okay, EBITDA, $240 million to $3.3 billion. That's outstanding. That is mental math, roughly 14 times growth over the decade. Let's check that. It's getting late. 13.8, not bad for a late night show. All right, 14 times growth in the EBITDA over that period of time, which is fantastic. You'll also know that the growth rate, 43.2%, that's the kind of annualized over that time growth rate versus the 29% on revenue. That means margins are expanding. So as Salesforce.com grows in size, they're gaining operating leverage. That's what's called when your economies of scale. Other people call it operating leverage, but that's leading to margin expansion, which is great to see. Let's take a look at enterprise value and look at leverage. So debt, all long-term debt, it's relatively small. It starts at 0. Kudos to them for being debt-free. Very many people are debt-free, let alone companies are debt-free, but goes to $3.7 billion. But don't let that fool you, because they have $3.8 billion in cash at the end of the last fiscal year, so they can clearly wipe out all debt with cash. This is like some Benjamin Graham kind of stuff where you can pay for all debt in cash, and really like to see that. Kudos to them for keeping that on hand. So basically, you can net these two out. Debt is 0. That's nice to see. Market cap went from $15 to $150 billion over that period of time, largely due to the EBITDA expansion that they received. So enterprise value with essentially 0 debt is the same as market cap, or very close, 14 to 150 billion. And again, EBITDA growth drove that increase. Let's take a look at the enterprise value to EBITDA ratio. Now, this is our market multiple. Some people use earnings per share, or excuse me, a price to earnings ratio. Because we're looking at the enterprise as a whole, we're going to use EBITDA as the proxy for earnings. So enterprise value divided by EBITDA is the standard for this. And you're going to see how it traded over the period of time. The high of 101 times. That is a lot to pay. That's essentially 101 years, excuse me, 111 times. And that's 111 years of the EBITDA rate that we had back here of 326 million, that you're paying 111 times that at the entrance point. Now, obviously, they're buying it for growth. That EBITDA didn't stay there. It continued to grow to 3.3 billion. So you're paying definitely a growth premium. It's currently at 46, call it 48 times, which is very, dare I say, expensive. It is. Realistically, in this market, you've got other growth companies that are not nearly that expensive, that don't have debt and so forth. But we'll see if it pans out, what we think the forecast can be, and where, if it's reasonable or not. But make no mistake about it, it is expensive. And one thing I want to point out here is you're going to see, as when they were younger, say less than $1 billion of EBITDA, the growth premium here that you're paying for the company is higher. So this average at 60, 62 times earnings, all the way to this 40, it's averaging 72 times. But then as they grow, as they realize that growth, that average EBITDA multiple comes down. It went from 72 to then the back half of this tenor, it is 46. So it dropped 30 times. So it went from 76 to 46, or 72 to 46, whatever I said. That's a massive drop in the premium people are willing to pay for the growth. And as they grow, you should expect that EBITDA multiple to continue to decline over time as the growth people are projecting upon Salesforce is realized. The odds that they grow even higher become smaller, and they're willing to pay a lower premium for that. So in our forecast, we're definitely going to take this 45 number and we're going to bring it down to make sure the investment can still support a lower exit multiple in the future. Last column here is the debt one. We said debt's zero. These numbers here don't net debt with cash, so you can ignore it. It's zero. Let's go look at cash flow now. Really, rubber meets the road. My personal financial statement, my personal favorite financial statement, the cash flow. We pick up from cash flow from operations. Now, this is cash money generated. They sell their software as a service, subscription service, and they recognize the revenue for the full year ahead of time, and then but only get the cash on a monthly basis. So what they'll do is the revenue will hit all at once, right? And then they get the cash over time. So it's very important to look at cash money at all of these subscription companies to make sure they're actually getting what they say they're getting on the P&L. And lo and behold, look at the growth rate, 28%. That jives with the 29%, memory's doing right, 29% of revenue, 28% on cash flow from operations. EBITDA was a little higher. EBITDA was 42%. So there's a little bit of a delta there, but I'm not concerned by it because it's jiving with revenue and they're both really big double-digit numbers. So they go from $600 million to $4.3 billion in cash flow from operations. CapEx, look how tiny this number is. This is, I mean, breathtaking. It's a thing of beauty, really. So let me get this straight. Last year, they made $4.3 billion in cash from running their business. And the only thing they had to put back in the business is $640 million. That's fantastic. That's like 20% of what they earned. Let's check the mental math. 15. Close enough. So they make $4.3 billion. They only have to put 15% of that back. That's amazing. Some of the bigger companies we've looked at, like the oil companies and some of the big industrials, right? They're putting 100% back. They're putting 50%. These guys are putting 15% back. That means all this cash goes all the way through to the free cash flow to equity. There's no debt payments, essentially. This is little ins and outs, but it's essentially zero. And that's fantastic. So that means that free cash flow to equity is then divided by shares outstanding to give you free cash flow per share and that is very, very strong. I will say one comment. I was surprised to see this, in all honesty. A growing share count outstanding is surprising. 5% every year, year over year, when they're making this much jack. Why? They are making acquisitions. Okay, fine. They're paying a huge premium for those acquisitions, right? Tableau, $15 billion. That's got to be part of it shares that they're issuing to cover that expense. That's probably because they're paying too much of a premium. You can argue they shouldn't. They're growing. They're doing their job. Okay, so let's be mindful that they're diluting the existing shareholders to accomplish the growth rate. So if growth rate were to ever stall, you'd have a pretty hard hit on stock price because of the dilution. But I'm hoping that will calm down and they'll start buying shares back. Let's just finish off the sheet. So then yield is basically free cash flow per share divided by price. That's cash price. And then the growth rate strong, free cash flow growth rate 75%, yield 2.8%. Let's forecast now, shall we? The fun part. Okay. We're going to pick up free cash flow here at 3.6%. We're going to string it forward. And I'm going to give it a 20% growth rate. That's going to fall in line with our growth rate of EBITDA. I'm cutting the growth rate on free cash flow because of the dilution. I'm assuming another, I didn't use 5%, I used 2.5% going forward into the future for the share dilution. So I'm lowering the free cash flow growth rate slightly from the EBITDA that you'll see in a second to compensate for the added dilution in the shares. But essentially, it's 3x on the cash flow per share. So just following their historical growth rate, $4.36 all the way to $12.52. I apply a 3% yield on this, and I get $417 a share, which is a very strong share price. It's based on the strong cash flow and the strong growth that they've exhibited over the last almost decade. So kudos to them. All right, let's take a look at EBITDA and forecast EBITDA forward. So here we pick up with $4.3 billion of EBITDA next year. I'm growing year over year by 30%. If you recall, they're growing at 43%, 42%. I've haircut a little bit to provide a little bit of cushion for us. And I'm basically reducing that annually as we go down over the time. That's averaging is 18% annual growth for the decade, which is still very strong. And it's basically saying they're going to continue to be able to find some acquisitions here and there to grow their offering. They're going to continue to upsell existing clients the rest of their portfolio, as well as expand into other markets like they have been doing. That puts a earnings target, EBITDA target of $17 billion out a decade. I am assigning it a 20 times EBITDA at enterprise value. Again, continuing our pattern of stair-stepping down the EBITDA multiple from its current 45, 48 range down to 20 as in another decade. As the business fully matures, growth rate declines, market multiple comes down. So that means $343 billion of enterprise value, less debt plus cash. This is just me carrying ratios in the past forward. It's essentially zero. It's probably $3 billion of excess, but it's essentially zero. Shares diluted outstanding here. So I'm taking the existing shares they have and I'm continuing to dilute them 2.5% for the decade, and I get roughly 1 billion shares outstanding. That gives me a $313 price target for the EBITDA market multiple. Okay. Now we've got two price targets. We've got a free cash flow at roughly 400, and we've got an EBITDA market multiple at roughly 300. What we're going to do is we're going to split the difference, and we're going to come out with $365 as the price target in a decade. It's currently at $190 a share. Let's throw that into an IRR calculation and see what it looks like. So it's 190 in. I get some cash flow here. Again, this isn't your dividend. This, if you bought the whole company, you could distribute the free cash flow in its entirety. But it would give you a pattern of cash flows like this. If the company does not distribute this and they reinvest it, let's hope they're reinvesting for acquisitions to grow ahead of this IRR number. But this would be the cash flow, and you'd exit at 360, our number for an IRR of 11% annualized over that time frame, or roughly 2.4 times cash on cash. So 11% is decent, very decent. It's probably a little under what you're expecting given the historical growth rate of this business. There's one caveat I wanted to represent or tell you. It's here, it's the selection of which market evaluation to utilize. There's a big delta between these two. The cash flow here seems to be very robust, and me bringing down the market multiple does impact the EBITDA valuation at 300. So for fun, I'm going to take all of the free cash flow method and say the new price target at 100%, the cash flow basis is $417. That gives you an IRR of 13%. So you moved up IRR 2% over the decade. That's definitely above market EBITDA. So I think it's going to be IRR. So I think if you get the upside of the cash flow valuation at 400, you get an extra 2% on the IRR over every year over time to give you some upside. Let's look at this as a distribution. So here we go. As the price moves around, it'll give you an idea what the IRR can be up or down based on the price. So we're at 190. As the price goes north, the IRR comes down, right? Because you're prepaying for the future growth. As it goes down, you get a nice IRR boost if you can get it. And I would take any of these and you can give it a 2% spread for that cash flow number we saw. If you can go from 350 on average to the 400 price target, it's worth an extra 2% IRR. So that is Salesforce.com. I have to say, I went back and forth on this analysis a lot. It's a very challenging company for me because it's trading at such a high premium. My natural cheapness is to not buy it. But when I continue to look at the earnings, read the 10K, the stellar management, the cash that it throws off, which is principally what we invest in cash, and to see that cash flow valuation above the valuation on the EBITDA multiple gave me the confidence to go ahead and say that this is a good investment. Salesforce.com, there's a lot to like here. Let's recap. We've got strong revenue growth, strong EBITDA growth, great cash flow, a stellar balance sheet, and it still is well priced, even at 190. It's rich for the market multiple, but on a cash flow basis, I get my arms around it. I feel comfortable with it. So look for it. Certainly, if it were to come down for some sort of reason, definitely try to pick some up. But strong investment in my opinion. All right, my name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. I really do like doing these videos and appreciate the comments and the feedback. Let me know what you want to see next. I've got a couple more tech companies coming, and then we'll spice up the topics. But comment, subscribe. Thanks for watching.